Well, good afternoon, everybody. Thank you for joining us. As Jason said, I am underwriting counsel for Old Republic National Title Insurance Company. We underwrite for 7 states in the Midwest out of my division. I also serve as sort of an in-house counsel for Old Republic Title's St. Louis direct operation that we have here. And kind of piggybacking off what Jason said, I do think YTP is a great idea. When I started, what my boss did was basically had me rotate through all of the different offices and roles that our direct op has, so I could kind of get an idea of how all of the different pieces fit together. And it was really beneficial that we have a direct op here for me to be able to do that and kind of get the bigger picture and how my role fits into that bigger picture and how everything works together. And I think doing presentations like this, and I've given this presentation a few times in Nebraska, they have a basic title school where for newer employees to go through some of the basics of title insurance. And I think it's a really good idea because I think what can happen, and it's a natural thing that happens, but what can happen is you're hired in your role as, say, an abstractor or an examiner or a processor or a closer, and you train with your supervisor and you get really good at your role, and that's great. But you don't always, again, see that bigger picture. You don't quite understand as the processor how my role works with the examiner and how it works with the closer and how we get to the end result and what even that end result might be. And I always think that's just kind of helpful to kind of know the bigger context, and it kind of helps put your position into perspective and why you're doing what you're doing, right? So the purpose of the presentation today is to kind of take a step back and do sort of like, a 500 foot or 1,000 foot or whatever overview of title insurance in general, and sort of what title insurance is, what the different roles are, and sort of how title insurance fits into the overall real estate home buying or mortgaging process. So again, it's just sort of a big, broad overview. And if you have any questions at any point, like I said, feel free to drop them in the chat. I'll try to answer them if I see them throughout, or I can get to them at the end. Also, my contact information was on that first slide, so feel free to reach out to me if you do have any questions that come up. So without further ado, we'll go ahead and get started. So the basic agenda for today is, again, talking about what is title insurance, what is the real estate process, what are some of the terms that you're going to see, and then sort of breaking it down into some of the different components of title insurance. So searching, looking at the risks, what is the title insurance commitment, what is the policy, agency versus directs, premium and rates, things like that. So that's what we're going to touch on today. So starting with the very, very basics, and this is a big, long statutory definition of what is title insurance. I won't read through the whole thing, but essentially title insurance business means issuing as an insurer or offering to issue as an insurer title insurance, right? Always a helpful definition. Transacting or proposing to transact one or more of the following activities when conducted or performed in contemplation of or in conjunction with the issue of a policy of title insurance. So we kind of skip down a little bit. What title insurance is, or part of title insurance, is guaranteeing, warranting, or otherwise ensuring the correctness of title searches for all instruments affecting titles to real property, any interest in real property, cooperative units, proprietary leases, etc., and for all liens or charges affecting the same. So again, we're basically warranting, well, that's not the best word, I would say, but we're ensuring the status of title. We're ensuring that title is clear for a prospective buyer or lender, and I'll kind of get into that a little bit more here in the next couple of slides. Along the same line, some of the other sort of components that go into title insurance business as a whole: handling of escrow, settlements or closings, signing title insurance policies, abstracting, searching or examining titles, issuing insured closing letters, guaranteeing, warranting, or ensuring searches or examinations of title, et cetera, et cetera. So again, that's sort of the big, broad definition of title insurance business. So we'll kind of break that down a little bit. The end result, after all of the kind of steps that we'll go through here, is the policy of title insurance. That's sort of the culmination of the title insurance business. It's what we do. We issue policies, right? And there are 2 main types of policies: the owner's and the loan. The loan policy is also called a lender's policy. It might be called a mortgagee's policy. You'll see sort of different terms interchanged for those. But essentially, the owner's policy is a policy of title insurance that insures the owner of real estate, right? That's pretty self-explanatory. And it's insuring against loss occasioned by any defects in, liens against, or unmarketability of the owner's title. So we're basically giving the owner a policy that says the title to your property is clear. There are no prior interests, other owners who can come along and say, I own this property. There are no liens against the title, so no other lender can try to foreclose out your interest that you just acquired. And we're ensuring that title is marketable. Again, there are no sort of lingering clouds or interests that would make it difficult or impossible for the owner to then go ahead and sell that property to someone else. That's kind of generally what we mean by ensuring marketable title. It's title that can be sold again and someone is willing to buy it. And then the loan policy, which again is also called the mortgage or mortgagee's policy, is a title policy ensuring the holder of a mortgage against the land. And again, it's ensuring against losses occasioned by the impairment of the validity of the lien or because of defects or superior liens against the title. So it's a key distinction to make because I think a lot of consumers don't quite understand the distinction between an owner's and a loan policy, particularly in the purchase situation, because now in the closing disclosure, right, the owner's policy is expressly listed as optional because you don't have to buy an owner's policy. And a lot of people think, well, there's a policy being issued to the lender, so it's fine, I don't have to worry about it. And that's not true because the owner's policy is what's ensuring the owner with their clear title. So if they have a claim, they would be covered. The loan policy only insures the lender, and it's ensuring that they have a valid mortgage lien and that there are no other basically defects in the title that would either impair the validity of the lien or the priority of it. So like a senior unreleased mortgage from a prior owner or a tax lien or something like that, that if the lender were to go to foreclose, that senior lien wouldn't be extinguished and suddenly that lender doesn't have marketable title if they buy it at the foreclosure, right? So it's a completely separate sort of policy that's ensuring the lender only. So an owner is not going to be covered by that. And that kind of gets into the whole, providing legal advice and can we advise the consumer to get an owner's policy, and sort of that walking that fine line of saying, well, it's a good idea, but I can't really give you legal advice about whether you should or not. That's something that they would need to talk to their own attorney about. But it is a common source of confusion. I think that owners don't quite understand that they aren't covered by the loan policy. Okay, so what do the policies insure? Well, it covers the property in question. The property is going to be described in a legal description, right? Whether that's meets and bounds or a lot and block, depending on if you're in a more rural or urban area. The legal description is going to describe the outline of the property, but it's not going to talk about what's on the property, right? We don't cover that in title insurance. And the policy essentially covers everything from the ground up. And that sort of goes back to an old legal concept that when you buy property, you basically get the column of air above the property and then the column of dirt essentially below the property, right? So unless, the minerals or something like that have been expressly conveyed out and you have a different owner of the minerals, theoretically, the conveyance of the land, the surface is going to include the minerals. By default, that's theoretically going to be covered in a policy, even though we generally don't expressly state that. It's kind of one of those implied coverages. And it's also important to remember, and I'll talk about this a little bit more as we go on, that the policy insures title as of the policy date, and it looks backwards up through the policy date. So most types of insurance, like homeowners insurance, car insurance, they look forward, right? You buy your policy, you continue to pay a premium, and then in the event something comes up in the future, you're covered. Title insurance is sort of the opposite. It's backwards looking. So we're performing our search of the property, we're looking at the history of it, right? We're making sure that every prior owner has conveyed their interest, every prior lien has been released, so that when our new consumer, our new buyer acquires their interest and that deed is recorded to the buyer, we can issue a policy stating that their title is clean as of that date, right? And we're looking backwards at everything prior to that point, making sure it was cleared. The policy doesn't look forward. So anything that happens post-policy is most likely not going to be covered. There is an extended homeowners policy that does provide some post-policy coverages. We won't get into that. But generally speaking, it's important to remember that title insurance is backwards looking. Everything prior to policy, anything post-policy is not going to be covered. So what do the policies not insure? Well, they don't insure the structures on the property. So, they don't insure like the dishwasher or the washing machine, things like that. That's what a homeowner's insurance policy covers, which again, there is, I think, some confusion there because a lot of consumers don't know what title insurance is necessarily. They assume that it goes along with the homeowner's policy and covers the same thing, but it's not. The homeowner policy is something that covers, the roof, things like that. Title insurance doesn't cover that. We also don't insure the address of the property because, again, addresses can change. A lot of times you'll see, and I shouldn't say a lot, sometimes you'll see the post office using one address, but the tax assessor records that we go off of use a different address because the post office doesn't necessarily have to use the same address. So we don't insure property address if you ever get that question. It does come up from time to time. Okay, so that's the policy, that's sort of the end result. So now we'll kind of take a step back and look at the beginnings of the title insurance process and then the sort of the real estate transaction and how those things fit together. So what is the process? Well, you guys probably know this. So generally the buyer finds a home they want to buy, they complete the sales agreement and they offer to give to the seller. The buyer borrower applies for a loan with the lender. This is an older presentation. These should probably be flipped, right? Because nowadays, in order to have really a fair shot at getting your offer in for a house, you really should have your application with the loan done first, right? And your pre-approval letter, but sort of you get the idea. The lender requires items to determine the true value of the property and how much money they can provide the buyer borrower, right? So they do their own underwriting, which is different than title insurance underwriting. They're looking at credit reports and bank accounts and all that kind of stuff. So then once that sort of gets put into place, the contract is accepted, the lender gets their file opened, they start underwriting the loan. That's when the title insurance company will typically get involved, either through the real estate agents sending the contract to their title agent that they typically work with and saying, here's a new file for a purchase, or the lender will send along the order, again, with the title company that they usually work with to say, here's a new order, please go ahead and open this file. It's a purchase, it's a refinance. So either way, that's essentially how we're sort of brought into the picture through the agent or through the lender. So again, either one will order a title commitment from the title company. The next step in the process is it moves to the exam, right? So we'll get the file open, we'll get all the basic information entered, the property address, a brief legal description that's on the contract, the owner information, things like that. We'll get all that into our system. The title company then orders the search and prepares the commitment based on that search. The commitment is then reviewed to determine the marketability of title, whether title can be transferred, whether it's insurable, because sometimes those are even two different things. You might have sufficient title to actually convey, but it's not sufficient to be insurable. Then once the commitment is issued, it's sent out to from the examiner, typically to the parties. It's sent to the closer and to the examiner. And we move on to the step of title clearing, which again, it basically involves obtaining tax information, payoffs, releases to clear the commitment requirements. Talk about that a little bit more as well. And then sort of the culmination of all of that, documents are signed, the keys are exchanged, the house has a new owner. And then after that, it moves on to the final title policy. And that's where our role basically is completed as far as the closing process. Obviously, if there's a claim down the road that gets filed, the underwriter is brought back in. But as far as this, the title insurance real estate process, our role sort of ends once the final title policy is issued and everybody goes on their happy way. So we'll kind of look at some of the elements of the real estate transaction process, and then we'll kind of get into breaking down those different steps of the title insurance process, right? So again, some of this might be information that you already know because it's pretty basic, but if you are brand new to the industry, brand new to the real estate field, this is some just very good basic information just to kind of keep in mind, because again, it's sort of explaining what happens in the real estate transaction, and then you can kind of piece that together in terms of what we do and how everything kind of fits together. So the most important, or one of the most important documents that's needed as far as the real estate transaction and the closing, is the deed. And this is the document that actually memorializes the conveyance of the property from one party to another. It's sort of like the receipt of the transaction. It gets recorded in the land records, so that way when a future examiner goes to pull the chain of title and they're going through all of the deeds, they'll find the deed from your seller to your buyer and say, okay, here's the latest in the chain of title. This shows the title has flowed through all of these owners through the years and ended up with your buyer who's now maybe trying to sell or refinance. It's all part of a greater title chain history of the property. It'll contain specific pertinent information, again, that's helpful for examiners when they're looking at a chain of title. It'll have the date that the transaction took place, the name of the grantors and the grantees, obviously. Well, I say obviously, you'd probably be surprised how often that information gets omitted from a deed, especially if someone is preparing their own. Marital status of the grantors and the grantees is key. And in Illinois, it's also key to know whether the property is homestead or non-homestead, because that will determine whether certain parties or certain spouses, I should say, who maybe are not on record title, they aren't a record owner, but they still have homestead rights and would have to sign a waiver to waive those homestead rights, which again is a separate issue that's really probably part of its own presentation. But something to keep in mind is marital status and the homestead or non-homestead status of the property. And then the consideration, the amount the property is being sold for. And again, this is part of an old legal concept that basically says, in order for there to be a valid exchange, there has to be some consideration given in exchange for the property being conveyed, right? It's sort of like a give and take. So back in the old days, the deeds used to state the actual amount of consideration. And then at some point, and this consensus is almost in all states, at some point, I think as, dollar amounts kept increasing and certain parties didn't want the public records to reflect how much someone paid for the property, courts essentially decided that you don't need to show the full amount of consideration that's being paid as long as you have some general reference to it. So a lot of deeds will say $1 or $10, which is sort of like a nominal consideration. And then there'll be a quote that says like, and other valuable consideration, right? So you don't have to put $500,000 or $700,000. You could just put that general $10 and other valuable consideration. And that's deemed sufficient to show that there was consideration for the transaction, thus making the deed and the conveyance valid. So if you see that and you're like, well, wait a second, why does it say $10? The property's obviously worth a lot more than that. That's why. It's sort of like a placeholder that says, yes, there was consideration, even though we're not listing the full dollar amount. And then the deed obviously has to be signed by the grantor in order to be valid, sort of like a contract. The grantor's signature is then acknowledged by a notary public or another official officer authorized to take the acknowledgement. And then, like I said, it gets recorded in the land records and it acts as sort of the receipt of the conveyance. So as far as the deed, it can convey title to people in different manners, right? If you have multiple grantees, they can hold title in different ways. And in Illinois, there's really 3 ways that individuals can hold title. And then there's also obviously in a corporation and an LLC and a trust, things like that, that we won't again necessarily get into because those are part of their own presentation. But mainly what you'll see is individuals taking title one of 3 different ways: tenants in common, joint tenants, or tenants by the entirety. So I'll skip ahead. So the default one is tenants in common. And these are important to remember too, because when we get to the title clearing stage of the commit or of the transaction process or the title insurance process, vesting can have a big difference on what we need to do in order to clear title and make it marketable or make it capable of being conveyed. Because if someone has died, the tenancy can really make a huge difference in terms of what happens. So the default tenancy, if you have multiple grantees, is called a tenancy in common. This is basically what happens if the deed conveys title to like Joe and Bob and there's nothing else stated. So it creates a tenancy in common. The key is, or I guess the drawback to this is that if one person dies, the interest doesn't automatically go to the surviving co-owners, right? A lot of people assume that. They just think that that logically makes sense, but that isn't what happens automatically. So if one person were to die, the interest then passes to either their estate or their heirs. So, you'd maybe have to require a probate estate through the courts. You'd have to get all of the heirs involved to sign off on deeds. It just kind of depends on timelines and things like that. So it's not necessarily a fatal defect, or it's not going to derail the transaction necessarily, but it does take additional steps. It does lengthen the time of things. It does potentially cost the seller more money. So like I said, it makes a big difference in terms of vesting and how it can affect the closing transaction. See. The other way to vest, or the other 2 ways, are joint tenancy and tenancy by the entireties. So a joint tenancy is essentially a way of ownership that, if properly done, if one owner dies, the interest passes to the surviving owners. It cleans things up. It makes it a lot simpler in the event someone dies. Essentially, the deed has to expressly state that the grantees take title as joint tenants, right? So the deed will convey title to Joe and Bob as joint tenants or as joint tenants with right of survivorship in order to create that tenancy. So you'll see that pretty frequently. If you have sophisticated parties, they're likely going to realize that we don't want to take title in the default tenancy in common. We want to be joint tenants. So you'll see that language in a deed. And then the last way is called the tenancy by the entireties. I actually have 2 slides on this. And essentially it's a modified joint tenancy that's only available to a husband and wife or married couples that take title and are actually married at the time, and that if the property is homestead. The deed again has to expressly vest them as tenants by the entirety. So it'll say Jane and Bob, husband and wife, as tenants by the entirety, or as tenants by the entirety, not joint tenants. Again, if the property is homestead. And it's again similar to a joint tenancy in that when one spouse dies, the interest will automatically pass to the other spouse, and it provides protection against one spouse's creditors against certain liens. So like a judgment lien against one spouse wouldn't attach to property that's owned by 2 spouses as tenants by the entirety, which again plays into the title clearing and examination phases that we'll talk about, because you're able to out certain liens and judgments that you would normally have to show in a commitment based on this vesting in the tenancy. So again, that's just kind of goes to show how important it is and the differences that can happen when title is vested in different ways. And if you work on, if you're down in an area where you work sort of on the Illinois and Missouri sides, I think some of our agents potentially do that, or you're coming from Missouri or something like that, it is important to note that to create a tenancy by the entirety in Illinois, it's very different than in Missouri and in Indiana, actually, on the other side. Because in Missouri and Indiana, it's automatic. If 2 spouses take title, they're deemed to create a T by E no matter what. In Illinois, the deed actually has to state that they are tenants by the entirety. So one little distinction there. Okay, so that is, so that's vesting issues and tenancy issues. The next sort of major issue that we see from a title insurance standpoint are liens. Because these are, again, they're encumbrances against the property. They're a hold or a claim on a thing for the satisfaction of the debt, right? So if someone is owed money, they can place a lien on title to real property as a way of securing that debt and making sure that they can be repaid, because the lien acts as an encumbrance, sort of like a cloud on title. And in order to release that lien, a creditor would have to be paid, right? They're not going to release their lien, their claim, their right to payment that's enforceable against the property unless they're going to be paid. And it basically provides the creditor the ability to collect their debt by reason of foreclosure. So some common types of liens are mortgages in Illinois, deeds of trust in some other states, judgment liens, real estate taxes, homeowners or condo association dues, and then certain municipality liens. So like I said, these are basically claims against the property for a debt. And if the creditor doesn't get paid, they can seek to enforce it by a foreclosure proceeding. So with a mortgage, they can file a judicial foreclosure proceeding. Judgments can be executed on, which is essentially a different form of foreclosure to go ahead and wipe out the, or it's not wipe out, but foreclose on and sell the property and then repay themselves out of the proceeds. Real estate taxes go through tax sales, again, for the same kind of general idea. The property is sold to repay the taxes. And then HOA and municipality liens can be foreclosed out as well. And again, the ultimate goal is to sell the property at typically a sheriff sale or a public auction. And then the debt that was, underlying that lien is then paid off out of the proceeds. So the mortgage is obviously, you're going to see this 98% probably of the time when you're examining a file. It's a document recorded of public record indicating that the buyer, borrower are using their property as collateral to a mortgage lender who is providing them with a loan to purchase the property. So this is what's called a consensual lien, right? It means the owner has consented to the mortgage, they've signed off on it, and it's basically a requirement of the lender in order to give the money to purchase the property. Again, it's security for the repayment of the debt, because if the borrower stops paying, the lender can foreclose on the property, sell it, pay themselves back out of the proceeds. So that's the whole idea behind a mortgage. Again, it gets recorded in the land records, typically behind the deed. Well, it should be behind the deed, right? Because you have a deed conveying title to the buyer, and then the mortgage from the buyer back to the lender as security for the debt to purchase the property. And again, it gets recorded in the land records as sort of a receipt of that transaction as well. And the mortgage serves as evidence of the lien against the property that would need to be cleared in order to ensure clear title down the road. So similar to a deed, the document's going to contain the borrower's name, the lender's name, the date of the transaction, the maturity date of the obligation, ideally, And then the mortgage is a two-party document, right? The borrower is basically conveying the mortgage or conveying the property to the lender in exchange and as security for the loan and repayment of the debt. Like a deed, they'll contain the legal description of the property, because again, that's how it gets indexed in the land records. When we're doing our search, everything will sort of be indexed to that legal description so we can follow along in the chain. So judgments, and then a couple of the other types of liens we'll talk about. These are what are considered non-consensual liens, right? The borrower or the owner of the property has not consented to the placement of this lien on the property. The lien arises by reason of the owner's failure to do something, right? So in the case of a judgment, typically what happens is the borrower has not, or the owner, excuse me, has not paid a debt. So like a credit card, for example. So the credit card company gets a judgment against the owner. If the judgment lien is recorded in the land records, similar to a deed and a mortgage, that creates a lien against the property. And again, it's security for that creditor so that they could foreclose, sell the property, and be repaid if they wanted to. But again, obviously not consensual, because obviously the borrower is not typically agreed to something like a judgment lien being placed on their property. It's because of their failure to pay that the creditor has pursued this remedy. Another type of lien is real estate taxes. So these arise automatically by state statute. Again, reporting and collection varies by state. Illinois is incredibly complicated, especially when it comes to the tax sales, because I did a presentation on this not too long ago, but it's like this year's tax sale is from taxes from 2 years ago that weren't paid last year. It's very complicated, but the real estate taxes arise automatically by statute. They're due by certain dates. And if they aren't paid, the liens arise automatically, and then they can be foreclosed out through a tax sale proceeding, which essentially extinguishes everyone's interests in the property. And then, the property is sold to a buyer who then pays the taxes, right, takes title. It's a bit of a complicated scheme in Illinois, to say the least. Again, it's a whole separate presentation, but the main takeaway is that taxes are another form of lien against the property that would need to be cleared for a title insurance purpose. Okay, so this is important as well. So we have the different types of liens, but what is lien position, right? So you might see another word for that is priority of liens. So how does a lien obtain its place in title? Because liens don't all share the same priority. There are first position liens, second position, and it has different impacts in terms of who would get paid in the event of a foreclosure or a forced sale of the property. So generally speaking, how does a lien obtain its place in title? The answer by and large is going to be the recording date or the rendered date. So it's really going to be the recording date in Illinois, because almost everything, well, with the exception of one thing that I can think of, are recorded in the land records. So for example, if you have a warranty deed vesting title in the buyer, then a mortgage is recorded, that's going to be first position priority. If a judgment lien is recorded after that, that's going to be junior to the mortgage, second position. If a tax lien is filed in the state tax lien registry next, that's going to be third position, right? So it follows the order that everything is basically either recorded or registered in the tax lien registry. And what that means is that if the lender on the mortgage, which is in the first position, if they foreclose on their mortgage and they name all of the junior creditors whose liens are subsequent to theirs, the foreclosure of the mortgage is going to extinguish all of those junior liens. So that way, when the mortgagee acquires title in the foreclosure sale, all those junior liens are automatically wiped out. However, if, say, the judgment creditor went to foreclose and they have a second position lien, their foreclosure will only extinguish liens junior to them. It won't extinguish a senior lien. So if you have a mortgage in first position and you have a second position judgment creditor foreclose, if they take title to the property at the sale, that senior mortgage hasn't been disturbed. So that's how lien priority comes into play, and why it's important, especially from a creditor's standpoint, in terms of if I were to foreclose, whose interests are going to be extinguished automatically, and then whose liens are going to remain. Because any liens that remain undisturbed would have to be paid in order for the creditor to release it, right? They're not just going to release their lien voluntarily because, oh, you foreclosed on your judgment. No, my lien's still valid. I want to be paid. It also makes a difference in terms of who gets paid out of the proceeds. So first position creditor would get paid first. Anything left over would go to the second position creditor. Anything left over would go to the third, and so on down the line until all the proceeds are paid. Generally speaking, since Usually at a foreclosure, the lender just sort of credit bids, right? They buy it for whatever they're owed. There are no extra proceeds, so all those junior creditors don't get paid, which again, it's just kind of like why that lien priority can be important in terms of how you're getting paid out of sales. Okay, so those are some of the items that impact title. So deeds, liens, kind of breaking down mortgages, tax liens, things like that. So now we'll kind of pivot back into how those documents or encumbrances sort of play into our role in the title insurance. So if we kind of think back to the real estate process, so the lender or the real estate agent has placed their order for a commitment with us, right? So the next thing we'll do is we'll open the file, we'll get all of the basic information in, and then we'll start our search. Well, so what is the search, right? That's the next step in the process. So it's a search or an abstract. It's a detailed description of the property information. So when we're talking about a search, we're looking at information from the tax assessor's office, court records, and the recorder's of deeds office in the county where the property is located. So as part of the search, we're looking at a few different things. We're looking at the parcel identification number. We're looking at the assessed value for tax purposes from the assessor's website to kind of make sure that our sales price roughly correlates to that. The property's not being sold out from under someone from less than it's truly worth. And then we're looking at who the current owners are according to the deed chain, everything of record. We're looking for open mortgages. We're looking for open judgment liens, delinquent tax information. And then again, along those same lines, any other liens and encumbrances that might be against the property. So we're looking at the state tax lien registry for state tax liens. We're looking for federal tax liens that are recorded in the land records. We're looking for municipal liens that get recorded in the land records. Those are all going to be part of typically the recorder of deeds office books, right? When we're looking through everything as part of the chain, going from one to the next, seeing everything that's out there, and then matching up, are there releases for all of these items? And then are there deeds conveying all of the interests, right? So if you have a deed from A to B, do we find a deed from B to C, then C to D until we get to our current owner, right? Does it all match up? Similarly, if we find an open mortgage, here's a release for it. We can remove that one. Here's a judgment lien. Here's a satisfaction. We can remove that one. So it's a lot of matching this with that to make sure that everything is cleared up. And then things that aren't cleared up would then be reflected on our commitment that we'll talk about here in just a second. So there are different types of searches. You might see this, especially if you're on the production side of things. And even if you're a closer and one of your regular customers contacts you about a different type of search. So there's things called like a deed only or a current owner search. It's also called something like a letter report or an owner and encumbrance report. These aren't necessarily title insurance products. They're basically just a search of the property, right? So you as the escrow agent would have your own sort of document that basically says, here's a summary of the current status of title. Here's who we show as the current owner. Here's what we show as the current liens on title. There you go. And a lot of times lenders will request that for a foreclosure so they know what's out there. Or an investor may ask for just a brief like deed search just to see what's out there. If they were to buy the property, what issues they would run up against. And then there's the full search, right? That typically goes back at least 40 years or length of time required by different statutes. Again, depending on the type of property, whether it's a purchase or refinance, things like that. But the full search is what we're looking for in order to prepare the commitment, right? We're doing the full search back through the chain. All right, so now this is sort of the important part. So we've done our search, we've sort of matched up everything, and we have some lingering issues out there that haven't been quite resolved according to the documents in the chain. So then as we're preparing the commitment, we're sort of looking at the risk, right? Because at the end of the day, we're an insurance company, we take on some risk. There may be some things that we would be willing to look over based on passage of time or based on the context in the chain of title that, we may not actually have to like formally address it, even though there is something sort of wonky out there, we can overlook it. But what are some of the risks that we're looking at when we're preparing the commitment and then moving on in terms of clearing title? Well, are the people who are looking to sell or refinance in the order that we've placed and enter into our system, are they the current owners in the deed chain? So there's times where these will be different, where you have a contract signed by Bob, titles vested in Shirley. Why? What happened? So some common examples: the most recently recorded deed wasn't found. It was misindexed in the recorder's office for some reason. The order was placed for one person, but two were on the deed. Perhaps the missing person is deceased. Or again, if you have someone completely different signing the contract, It could be that the record owner is deceased, something like that. Those are actually pretty common issues. So then again, it's sort of looking at the information you have from the contract, looking at the deed chain and saying, okay, here's this mismatch. What requirements do I need to then make on my commitment in order to get all of this to even out so that the person on the contract can now actually sign and sell the property? Are there any lingering prior owner interests or stray interests affecting the property? Again, this can be fairly common. So a prior owner, for example, records a deed conveying property that has already been conveyed. You see this a lot, especially in rural areas where maybe an owner owns a large tract of land and they carve out a piece and then they convey the bigger piece, right, without less than accepting that piece that was previously carved out. So suddenly you kind of have competing ownerships because you have a deed for our little piece to Bob, and then you have a deed for the whole tract, including our piece, to Jane. And it's like, okay, well, does Jane have an interest in our property? Probably not, because you can't convey what you don't own, but it's still sort of clouding title and it may need to be addressed. Another common scenario is that you have one of multiple owners who never conveyed their interest to a current owner. And again, a lot of times that owner may have died, but looking back at that tenancy, just because they died, their interest might not have gone away, right? We might have to get the heirs involved, a probate might be involved, things like that. So those are common issues that you'll see as you're looking through the chain. And again, sort of those things that aren't quite matching up. When was the last time the property changed owners? Was the property purchased for true consideration and like a warranty deed? Is it a family member deal? Those can be really a nightmare, especially when people are preparing all of their own deeds. Were the appropriate transfer stamps paid? Is there enough time between the last purchase of the property and the current day for the property to appreciate that much? In other words, are your sellers trying to flip the property? Flipping on its own is not necessarily a problem unless you have a situation where, say, like the original seller is an attorney in fact signing as power of attorney for your elderly seller, selling the property for $20,000, then your middle buyer is turning around and selling it for $100,000 to someone else. That could be a problem because that seller, if they find out, could then say that that transaction was invalid because the attorney in fact breached their fiduciary duties or something like that. So if you have huge jumps in the properties between like a purchase one and then turning around purchase two, those might be some red flags that we need to look into a little bit more. Some more risks. How many open mortgages are on the property? So again, for example, our direct op will send out a seller letter to sellers to basically say, you know, how long have you owned the property? What are your current mortgages? Who is your sewer company? Things like that. So a lot of times the letter will come back and say, I have one mortgage with Chase, but our title search will show two open mortgages, one with Chase, an older one with US Bank that again, we don't have the recorded release to match up to. This is fairly common because what will happen a lot of times is the older one will be refinanced and the lender just never gets around to releasing it. But it's a problem, right? Because now there's a lien that's still out there affecting title. US Bank could theoretically try to foreclose on it, which would create a whole lot of problems. So for title clearing purposes, again, it's something we would have to look at. Kind of the same idea, the order information for one payoff, but you have two mortgages. The oldest mortgage should have been paid off, but it was never released, things like that. So then we sort of take all of that information and we put it into the examiner will put it into the commitment. So the commitment is the contract that we issue that basically says, upon the completion of the requirements in Schedule B1, we will agree to issue you a policy of title insurance subject to the exceptions appearing on Schedule B2, which are basically recorded matters affecting title that don't get released. Things like restrictions, easements, things like that. If certain liens aren't going to be released, sometimes they can be shown as exceptions. It's important to note though, that the commitment is not a report, a legal opinion, or other abstract or representation of title. Real quick, the example I like to use to sort of show the difference between a commitment and an abstract of title, because again, an abstract or report isn't necessarily a title insurance product. The commitment is the contract to insure. So there may be situations where on a commitment insuring side, the underwriter is willing to overlook something like, say, an unreleased mortgage because we have a current owner's policy and indemnity letter to rely on from a different underwriter. So then we could remove it from the commitment and issue a new policy without exception for that mortgage, even though it's technically still unreleased in the chain. But if you were just doing a report of title that shows the current status of everything, that's not an insurance product, right? So we wouldn't rely on an indemnity letter because we're not issuing an insurance product, a commitment, or a policy. You would have to show that theoretically unreleased open mortgage because it is a lien affecting title, right? And the report is basically showing the current status, who the current owners are, what the current liens are. So that's sort of an example I like to use to show the difference between the commitment and something like a report. So the commitment is issued by the title agent on behalf of the underwriter. The underwriter is who the policy and the commitment are written on. We basically accept the risk, and in the event of a claim, it would come to us and we would pay out any losses. So there, like I said, there are 3 sections to the commitment: Schedule A, Schedule B1, and Schedule B2. Schedule A, I'll just run through these really quickly. And if anybody would like to have these slides afterwards, just send me an email. I'm happy to forward them so you can kind of have it as a refresher. But Schedule A is basically the who, what, where, when, why, right? It shows the proposed insured, which is the who. That's going to be your buyer and or your lender. It's going to show who the current owner of the property is. It's going to show the legal description and the interest that the current owner has in that legal description, whether it's fee simple, leasehold, an easement, things like that. So that's the who, what, where, when, right? Oh, and how much, that's important too. How much, obviously, right? That's going to be the amount of your policy. So in the case of an owner's policy, that's typically going to be your purchase price. And then for your loan policy, that's going to be the amount of your mortgage. So Schedule B1 is your requirements. So this is where we take all of that information that we've looked at and any of those items that are lingering out there on title that don't have sort of that corresponding document to out it. So like if a mortgage doesn't have a recorded release, or we have a deed into A without a deed out of A, those are where you take all of those things and draft them into your requirements that you would put on Schedule B1, right? So you'd have your standard requirements that make sense, right? The general warranty deed from your current seller to your buyer, your new mortgage from your buyer to the lender as part of those 2 policies that you're agreeing to issue. A release for the current owner's mortgage, because it would make sense that there's not a release for that one yet, because typically, by and large, people don't own properties long enough for a 30-year mortgage to just be released on its own and fully paid off. We see that sometimes, but generally the current owner mortgage is going to be paid off. But then you would also need to draft requirements for any of those older lingering items, right? So if you're missing a deed from someone, you would put a requirement in for a deed from that person or some sort of explanation as to what happened to them. Any outstanding prior owner mortgages or prior owner liens, you would show those and require releases, because again, they're still out there affecting title because we don't have that corresponding document capable of clearing it. And then Schedule B2, these are the exceptions. So this basically is the schedule that says after all of those requirements on Schedule B1 are met, all the title is cleared. These are the exceptions that are still going to remain. They're going to be excluded from coverage under your policy. So standard things like recorded covenants and restrictions for a subdivision or a condo, easements affecting title, things like that that just sort of run through the chain, covenants that run with the land that don't get released. Let's see. And certain endorsements can be provided to provide certain coverages or assurances regarding these exceptions. Again, that's really sort of getting further into the weeds of title insurance policy. That could be its own separate presentation, but generally speaking, B2 is where you're going to see all of the exceptions that will be excluded from coverage. These are some common endorsements, but again, we don't need to get into those. Okay, so final couple steps here that I'll go through real quick. So once the commitment is issued, right, we have that Schedule B1 showing all of the requirements that need to be cleared in order for that buyer to have good title or clear title at the end, right? And for us to be able to issue a policy free of all of those basically, encumbrances out there affecting title. So title clearing, it kind of, it means what it sounds like. Meeting the requirements on the commitment in order to ensure that the lender will be in first lien position and the homeowner will have clear title with no other vested owners or outstanding encumbrances against the property. So some examples of what a processor would typically do for title clearing: obtaining payoffs to make sure that all of the existing liens are paid off in full. If you're dealing with sort of prior owner mortgages or liens, contacting those creditors and saying, hey, this person no longer owns the property. Was this paid off as part of a prior transaction? If so, can you please provide a release? If not, what do you need in order to provide a release? Determine with 100% certainty that the lien doesn't apply to the buyer, seller, borrower of the property. That's another option. So being able to compare, say, like social security numbers or the last four on certain tax liens, so that we can say it's not our person, it doesn't attach. Sometimes getting an affidavit from the owner, if we have someone with a common name like Bob Smith, stating that this lien is against someone else with my same name. So all of that kind of goes into clearing title, with the end goal being that all of those outstanding matters that are shown on Schedule B1 that are needing to be released are being taken care of, so that at closing, we're paying the correct parties who are going to release those liens, or we have releases of those liens. So as we're going through closing, those can all be scratched off and basically said, this is being taken care of, this will be released, this will be released, so that when the policy department gets it, they know they don't have to reflect any of those matters. They can all be removed, and we can just issue a policy with those exceptions on Schedule B2 that we already knew about that don't get deleted, right? So that's what we're talking about with clearing title. One thing to kind of keep in mind when you're clearing title are HELOC mortgages. These are risky because what can happen is a lender can give you a payoff showing a zero balance on a HELOC today for a closing, let's say, happening on Friday. And in between that point in time, if the HELOC hasn't been frozen or closed, the borrower can rack up, the HELOC, and this has actually happened. The borrower can take out a $10,000 advance on the HELOC, get that money, and if we don't get an updated payoff, which we wouldn't necessarily do that, because why would we have reason to get a new payoff 4 days later? And we go ahead and close and don't pay, the lender's not going to release their HELOC mortgage because there's now an outstanding balance. But we will insure without exception for it, because we are under the assumption that there's a zero balance and it's going to be released, right? So then that could potentially lead to a claim. And I know personally we have had claims from that happening with HELOCs where, the borrower is kind of doing something they shouldn't, and it ends up there being an outstanding balance that we weren't aware of. So it's always important when you see a credit line or a HELOC to make sure that in addition to that payoff, we're confirming that the account is frozen, that the seller cannot draw any more money off of it between the time you get the payoff and the time of closing. Okay, so the final step, we've reached the end. So title is cleared and everything is ready to go. Closing happens. So the file is processed, all of the requirements are ready to be met. The closing settlement occurs. So basically, that's where the settlement statement is prepared, showing all of the figures, right? So the sales price, the new loan, the debits and credits for the prorations, all of those things are reflected. Everyone signs off on their respective documents. The money is exchanged, everything is funded, the documents get recorded to transfer title, the keys are exchanged on the real estate side, and everything is complete. And again, just another quick reminder, I know you guys have seen this before, but it's still very prevalent, the whole business email compromise, the fraudsters that will basically send fraudulent emails, always right around the end of the month when everyone's really busy, to basically, the most common one is to try to change wiring instructions, right? So it'll look like the closer has sent an email to the customer saying, oh, please send the money here now, instead of the prior wire instructions that we sent to you. And that's going to be fraudulent, right? It's going to be a fraudulent account. So just making sure your customers are always aware of the fact that, if you get last minute wiring instructions right before closing, call you with the number that they already have provided for you, because a lot of times those emails will contain a fake number to call you that won't actually go to you, right? So just important to communicate that, I would say, to all customers at the beginning. Here's how to reach me at all times. Please be aware that this could happen. If it does, let us know, and we can verify whether or not that is a true email. All right, and then the last step. So after closing occurs, everything moves on to the policy department, and the actual policy is issued to the buyer or the lender. So the policy department will typically take that commitment that will have been marked up by the closer at closing. So all of those requirements that were showing outstanding will be marked through to say that they've been satisfied. So then the final policy won't address those, right? You'll just get your policy showing the owner as the vested owner with those exceptions that were already on Schedule B, right, that weren't deleted. And they essentially have their policy ensuring that they have clear title. Similarly with the lender, they'll have their policy showing their mortgage in first position subject to those existing exceptions. Okay, so real quick, I think we've got 2 more slides. Again, those of you brand new to the industry, this might be new information. Otherwise, it's probably going to be old news. But again, the title agent is the person who actually issues the commitments and policies and signs them on behalf of the underwriter. They're typically the one that's actually handling the closing. The underwriter is the company that the agent represents. We're the insurer, right? So we're the ones actually insuring the property. So if there's a claim, that would come to us. And then a direct operation is basically like a wholly owned subsidiary of the underwriter, right? So I'm part of Old Republic Title Company of St. Louis, which is a wholly owned subsidiary of Old Republic National Title Insurance Company. It's sort of like a direct branch office for Old Republic. Premium for title insurance. Again, this might be good information if you're new. Unlike other insurances, like I mentioned before, you only pay premium once for a title insurance policy, unlike car insurance, right, that you pay every 6 months or a year. The policy covers events that occurred in the past, not what may happen in the future. The premium is calculated based on the purchase price or loan amount. Oh, and you can ignore this last one. I forgot to delete that from my Nebraska presentation. But in Illinois, you guys actually don't have a regulated premium yet. That's a stay tuned. But there are different rate setups in different states. So like I said, in Nebraska, it's all inclusive. So your premium rate includes your policy premium, search exams, all of that is wrapped into one premium charge. Illinois has no requirements. Missouri, we have filed premiums. So for example, the title insurance premium is filed with the Department of Insurance. So agents have to use that for the premium charge. But agents are also allowed to charge what's called a policy work charge, which would encompass things like searches, exams, all of that gets lumped into a separate work charge fee. And agents can charge whatever they want as far as their work charge, right? So the premiums are regulated, but the work charges are. It's kind of like a hybrid of the two. Okay, and there's our recap. So again, just kind of talking about everything that we discussed today. Again, the goal was to be like a 10,000-foot overview of title insurance, the real estate transaction, and how everything fits together. But if you have any questions, my contact information was on that first slide. Feel free to let me know. I'm happy to help. And it looks like we're right about at an hour. So I will turn it back over to Brian. And thanks again for tuning in.
Thank you very much, Cullen. Appreciate everybody's time here over the past hour. Any final words or questions? I'm trying to check here. A thank you in the Q&A. So a confirmation, Cullen, that it was worthwhile for folks' time today. Thanks again for everyone's attendance. This has been recorded and we will be sharing the presentation information tomorrow. Anything to close out, Cullen or Jason, before we give everybody back their day?
No, thanks.
I don't think so. Yeah. Thanks again.
All right. Well, thank you. Hope everyone has a good rest of the day.